Today, peak LNG stupidity. Hello again, it's Martin North from Digital Finance Analytics. We're on the latest post covering finance and property news. Well, Bloomberg reported yesterday that the US has become the world's largest exporter of liquefied natural gas for the first time, with 2023 shipments overtaking leading suppliers Australia and Qatar. The US exported 91.2 million metric tons of LNG in 2023. That's a record for the country, according to data through to the end of the year. The expanded output was due to last year's restart of Freeport LNG in Texas, which had been shuttered for months following a June 2022 fire and explosion. Qatar, the top LNG supplier in 2022, saw its volume shrink for the first time since at least 2016, with a 1.9% decline, dropping the nation into third spot for shipments of the super chilled fuel. Australia ranked second, with exports that were little changed from 2022. This year, 2 new LNG projects in the US are due to start production: the Venture Global LNG facility in Louisiana and Golden Pass in Texas, which is a joint venture between ExxonMobil and Qatar Energy. At full capacity, the 2 projects would add another 38 million tons a year from the US. Now, Australia's Department of Industry, Science and Resources forecasts that US LNG production will grow to 93 million tons by 2025 and to 134 million tons by 2028, while Australian LNG production is expected to remain steady at around 82 million throughout most of the decade. US LNG exports remain strong through 2023, with substantial redirection to Europe occurring after LNG flows between Russia and Europe were stopped, the Department of Industry, Science and Resources said in their latest December quarterly report. Over 80% of US LNG was exported to Europe in 2022-23, and the trend is expected to largely hold as Europe continues to seek reliable alternatives to Russian pipeline gas. But unlike East Coast Australia, the US has a domestic gas reservation scheme in place, which has largely succeeded in keeping domestic gas prices low. But of course, there is no reserving on the East Coast gas for domestic use in Australia, and it's one of the biggest policy blunders in Australia's history that's going to destroy what is left of our manufacturing industry in Australia, while rising the cost of living and inflation pressures for both households and businesses. And the mooted $80 billion deal between Woodside Energy and Santos could also put more upward pressure on Australian domestic gas prices. The 2 firms confirmed in December that they are in early stage discussions on a possible transaction. Santos said it was also reviewing other alternatives. They would have a combined market capitalization of around 80 billion Aussie dollars, with Perth-based Woodside accounting for almost 3/4 of that. In fact, Woodside has higher output than its smaller Australian rival. But by adding Santos, Woodside would create a regional energy champion in Asia, with more than 70% of its product mixing gas or LNG right on the doorstep of the industry's most important growth markets. That's according to UBS's Tom Allen. The energy assets that this combined company would have would be the envy of most of the players around the world, he said. Forecast 2024 output would rank the new entity among the world's 10 largest exploration and production companies by volume, UBS calculated. Now, agreeing on the deal will likely prove difficult, and synergies are expected to be small, potentially around $200 million to $400 million, because there's limited asset overlap, according to analysis by Evans and Partners. And Total Energies, BP, and ConocoPhillips could also be potential alternative buyers for Santos, according to Evans and Partners. Both Santos and Woodside are material domestic gas producers, which may create market concentration concerns, according to RBC capital markets analyst Gordon Ramsay. Now, it doesn't seem to me to make any sense to give any member of the gas export cartel, including Origin, Woodside, Santos, Exxon, or Shell, even greater control of gas import volumes. Remember, East Coast energy prices are driven by the marginal cost of LNG, thanks to no reservation policy. And whilst that global demand for LNG remains high, what it means is that domestic Australian costs are higher than perhaps they should be. It makes no sense, therefore, to allow further concentration. But as we've said before, the problem with the LNG story is that these international players have huge muscle, both financially and political influence, and so far the government has done very little to solve the underlying problem. This, of course, is a strategic blunder, as we've discussed many times before, and the net beneficiaries are the shareholders, most of whom are international, but the casualties are ordinary Australians and businesses who are paying through the nose through higher energy prices than they should. One reason why I think Australian inflation will be higher for longer. This is a mega policy mistake, or as I said, this is peak LNG stupidity. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.